Merci beaucoup, René. Très bonne
Thank
présentation et
you
merci à
very
tous.
much, Renee. Very good presentation. Thank you, everyone. And we appreciate your time. Everybody is very busy right now. Therefore, let's move on immediately to the presentation on the economy. This is a presentation held in cooperation with our group of economists at BMO. Therefore, deep down, when we look at the message, I'll start with my conclusion up front. It's an optimistic message that we have for you. And it's not just an optimistic message because we are a bank and because we have clients. It's our pleasure to present an optimistic message. It's optimistic because deep down, based on our models and everything we're looking into, there will be an acceleration for economic recovery. And of course, 2020 was completely different, without precedent. I know it's a term that was perhaps overused, but indeed, when looking at the collapse of the stock market, for example, that we experienced in February and in March 2020, we have to go back to 1929 to have a collapse of the stocks as sudden. And when we look at the recovery that was launched last year, when the stock market bounced back, then we have to look to 1933 to have an equally rapid rebound. And when we look into the economic history and we go way back to that period, we consider and think of the Great Depression, of course, and the Great Depression was brought on by many factors, among which very, very poor monetary policies as well as economic ones. Several politicians in England, more particularly at the time, were trying to balance their budget while the economy was collapsing. And it was absolutely not the right policy to undertake. And at the time, the monetary mass was greatly reduced, and by a great deal, which is the worst thing to do in a world requiring equity. So politicians and monetary authorities did learn lessons from that era. This is why we received an unprecedented stimulus. All central banks and developed countries launched hundreds of supportive policies to consumers, to people who unfortunately lost their employment due to COVID-19, and to companies and businesses as well. This was successful. Clearly, it caused the deficit or the debt to increase, and we'll address that in a moment. But it was really about the markets, the economists. We all looked to new COVID-19 data yet to be confirmed. We're not out of the woods yet, to put it such, but there's a great deal of optimism as regards the vaccine. I know there's some controversy revolving around vaccination. There's the Pfizer vaccine, Moderna vaccine, and the recently approved Johnson & Johnson vaccine. Seemingly, there's an acceleration in the pace of the vaccination process, and this is nonetheless very good news. And of course, Canada is lagging behind, and also compared to the US, because 20% of the population in the US at least received one vaccine dose. And President Biden did promise that from now to the end of May, which is coming up quickly, should uh, be supplied with enough vaccine for all of the adult population in Canada. We're talking about June and July. We shall see. But in any event, the trend is very, very positive in terms of the vaccination process. So a new president, in our opinion, this is a very good point. In my personal view, it's a very good thing for the world economy, because what happened, and this is not a political presentation, and you're not here to hear political opinions, but what's clear is that all the barriers imposed by Trump worldwide did cause a great deal of uncertainty. Only to say that Biden will remove the tariffs immediately, but clearly there will nonetheless be more predictability in terms of foreign policy and politics relating to the US. This is a good thing because when we put up barriers, it's very negative. Number one, it decreases potential growth of the world economy. And secondly, it's like a consumer spending tax. And so I think that Biden's approach, which has already been shown, the approach will be very different and probably positive as regards our greatest commercial and business partner. And this is not very intuitive, what I'm going to say, but finally, when we look back to the history of the economy, if we go back all the way to the start of this century, the last century, we see that the market performance was clearly superior when a Democratic president is in the White House. And again, this could take certain people aback because Republicans define themselves as being the market party versus regulations and things of the sort. But ultimately, history is very clear. The numbers, when a Democratic president uh, is in the White House, all is superior. And this is partly because Hoover was a president during the Great Depression as a Republican, and also George W. Bush, who was president during the last financial crisis. And the Democrats did benefit or benefit the recovery. And I found this to be interesting as a point to mention. And so we were talking about the stock market. We are at historical summits, and this could take certain people by surprise. Several clients called me up and said, "This is strange. We're talking about a second wave, perhaps a third wave for COVID-19, and there's a cost, an impact on Quebec, and the stock market can reach the summit, record summits." And the response, in our opinion, the answer to this is clear to us. The stock market is one of the best indicators for the real economy. In other terms, stocks are starting to increase 3 to 6 months before we start seeing a rising trend in the economy, in corporate surveys, in consumer spending surveys, or consumer confidence, such indicators or benchmarks that are useful and that we use in our own models. In other words, what the markets are trying to tell us is that there will be a very high and strong economic recovery. And we're going to talk about our forecasts in a moment, but there are certain of our research partners who are referring to a GDP growth of almost 11%. We're at 6.5%, but the bias is really on the rise. And these are numbers we haven't seen in decades. And of course, this is following the economic decline and that of the stock market we experienced last year. Again, what's interesting is that the history rhymes. It's not repetitive, but it rhymes. And often what we see in the markets is that there's an overreaction on the rise and on the decline. And last year was an overreaction on the decline. And the more violent the reaction, the more powerful the reaction to the contrary. And so we stretch it very far, and now we're on the right side of the trend, whereby the economy is clearly on the rise. Another thing that's interesting to note, in the right-hand graph, you'll see the U.S. corporate bond spreads. This is super important to look at the fixed income market to have an indication. And finally, the fixed income market gave us advanced indicators that there were severe issues. Furthermore, in 2008, and we know how this concluded, it was a crisis. It wasn't just a stock market crisis. It was a global recession that was triggered by poor practices in the area of the American real estate market. Based on the history, we can dwell on it longer. What's clear, however, is what we have seen in the stock markets is nonetheless sustained due to the resilience and the strength we see in the bond market. This is telling us that the bond market reopened very rapidly in terms of the central bank and government support. This enabled businesses to refund and refinance their net and to come back with strength, which is what we're seeing now. Therefore, we told you what is interesting is that China controlled the pandemic, which started in Wuhan, and China exercised better control than any other major country. Therefore, China did succeed in experiencing a positive, a real GDP growth. And we're talking here about 8%. And as I said, we're talking about 6.5% in the US, but it could increase. We're talking about 6% in Canada. And again, I think it's going to be on the rise, and partly due to the strength we see in raw materials and petroleum and other areas. This is the strength of the Chinese recovery and the American recovery, which creates a great deal of demand in this sector. What is interesting when we look at the history and the studies on the major factors and the most important ones for the Canadian dollar and for the TSX, it's the price of oil, petroleum, and there's a trend. Clearly, this helps certain provinces far more than Quebec. Of course, it helps Alberta, Saskatchewan, and Newfoundland to a certain degree. Therefore, good recovery. This is what we are witnessing in the markets. Another thing that's interesting is that it's not just about the increase of the markets per se. It's really to turn to the sectors that are growing and the typical ones that are led by the financial trends. And these actions are at the helm. And we think that there will be a very good performance in various industries for the next year at least. And one thing that's interesting, this is one of the themes we're working on a great deal. We're talking about huge support for consumers, especially for the second part of 2021, while the majority of the population will have obtained a vaccine against COVID-19, we'll see reopening of restaurants, cinemas, and there'll be more traveling. And of course, this will be far later in 2021. But again, the stock market is an advanced indicator, and the markets will start reflecting this reality before we actually see concrete evidence on this. And what's clear is that there's a great deal of demand by consumers, which is another sector which will really support the economic recovery. And when looking to the forecast for growths of the various provinces, well, Alberta is at the top, as I would like to mention, and you see the green horizontal bars. Those are oil petroleum producers, and so the recovery will be super useful to these producers. And of course, the manufacturing industry in Ontario and in Quebec will assist these provinces after a rather challenging year 2020. Now, unemployment rates. Unemployment rates are important to talk about because pre-COVID, we were at a 3.5% rate, which is very, very low in the historical merge. And so for our country offers a very, very good performance. And currently we're at 8.2%, which is not ideal as an unemployment rate. But given that the economy is recovering, it's very consistent with the message we are introducing here. Companies will start hiring again. And what's clear is that hiring of full-time employees always takes some time, and it's always a countdown indicator. We're at 8.2% in Canada, 6.2% in the US, but it's not totally negative in terms of macroeconomics. Of course, for restaurant employees and entertainment, hospitality who've lost their job, it's a very challenging situation. Certainly, we're considering them, and we wish them a sooner and earlier reopening than later. What this offers in terms of macroeconomics and the positive aspect behind it is that's going to push the inflationist factors. There's a great deal of concern and questions on inflation right now. And again, due to the economic recovery that's being launched and the price of raw materials on the rise. Historically, when we stumble into this inflationist spiral or whirlpool, which is rather risky, it's almost always due to the lowering unemployment rates, causing uh, others, of course, to be on the rise or the increase, even for professionals that weren't necessarily impacted by COVID-19. They preserved their salary and everything. There isn't too much pressure on the increase of salaries at the moment. It could happen, however, in 2022, for example. We'll take a look at this because once again, inflation is consistent with certain recoveries historically because it forces central banks to increase their interest rates. What we saw by Powell, it's a message. It's a message without any surprise, but it's very, very optimistic for the stock market and for the economy in general. And the Federal Reserve is not ready to increase until 2023, which will mean that the Bank of Canada will not increase either before 2023, and short-term interest rates have remained very, very low, which will sustain the economic recovery. But there's the flip side. The flip side to the coin, the long-term rates, and they have really increased and have taken many investors aback to see the speed of the increase of interest rates, 10 years, 30 years, long-term interest rates finally, while we were with lows we hadn't seen in decades. And of course, the American dollar increased to 1.75 this morning. We're not far from that in Canada either. So this is something that we must consider. In our opinion, it's not a massive increase, significant enough to delete the recovery. Of course, we don't want long-term interest rates to increase to 2.5 to 3% or by 2.5 or 3%, because this would exert a great deal of pressure on funding costs. It would especially exert pressures on public funding and programs. All these support programs have donated a great deal of money. We're talking about deficits in the area of 16%. We've never seen this since the Second World War. So for interest rates must remain low for several reasons, and also for multiple assessments and evaluations of stocks and equities. But again, there's good news in all of this. The performance curve. And when we refer to this, we're referring to the difference between long-term rates and short-term rates. And as the curve is steep, the more a good indicator of the recovery forthcoming. As stated, the stock market, the TSX, and PC 500, they're very good advanced indicators of the real economy. And the performance curve is a very good advanced indicator for the stock market and for the economy, but even more so advanced for 1 year, or provides 1 to 2 years advanced indicators. And we've been at a summit for several years when referring to the variance in rates. And again, historically, when in a central environment, those cyclical actions and stocks, equities tend to better perform financials, industrials, and discretionary consumer companies. And if we look at income and savings, now, of course, we're talking about 200 billion in surplus savings. Many people have kept their salary and they weren't able to spend it. No traveling down south, restaurants were closed, shut down. And so this caused a great deal of surplus savings. And so now we don't expect people to spend all of their savings from now to the end of 2021, but there'll be an acceleration curve, a very impressive one, on the discretionary expenditures. And we see this in the real estate market. But let's think of the automotive, ATVs, even campers, Winnebagos, and trailers, everything that is part of the discretionary spending. All companies involved in this industry should see a better performance. In fact, airline carriers should benefit from this rising demand in travel. We'll see in the next year. Again, it'll depend on the pace of the vaccination process, but there's nonetheless a great deal of potential. This has never been seen in our area and in our markets. Now, this time it's different because we've had far fewer bankruptcies. And of course, the recession lasted 2 months, one of the shortest historically speaking. And we've had very, very few bankruptcies in terms of businesses owned by retailers or individuals, certainly fewer than in '08 and '09. And this, of course, as a result of the government support programs that we're grateful for. And so this helps the recovery. We're not starting from scratch with the economy. Individuals and businesses, not all bars and restaurants will survive, unfortunately for them, but 95%, for 95% of the economy, we've pulled out of it fairly well nonetheless. We spoke to you of the budget. Of course, we're going to have to control expenditure, and we can't expect decreases in taxes. I think the government is very focused on the economic recovery to try to pull out of this tumultuous economy above all and foremost, and then we shall see. We spoke of inflation outlook. Let's talk about the housing market. And what we've seen a surge in terms of real estate. This is clear. And it wasn't Toronto and Vancouver that have seen the greatest increases. It was rather the smaller towns outside of the largest urban centers. There was a 25% increase. When talking about Mont Tremblant, try to buy a cottage in Mont Tremblant. Prices have increased by 35 to 40%. Same thing in the Toronto area in terms of cottages or secondary housing. It's a boom in one's backyard. And again, this will stimulate the recovery, a great deal of activity and lumber as well. This too will support the Quebec economy and the BC economy. All raw materials on the rise will support and help Canada concretely. And this is why we strongly believed that Canadian stock equities will perform, and in the US for the first time since 2016. And so we have a resumption of the price of petroleum, and look at the Canadian statistics, which have increased greatly since last March. And we believe there could still be an increase in the Canadian dollar by 3 to 4 or 5 cents, especially in the area of petroleum and oil if the summit is sustained. On this is the last slide and the last graph we wanted to show you. These are the sectors most impacted upon by the pandemic, which account for a small proportion of our economy. When looking at the Quebec economy, the technology sector is super important, and it wasn't particularly impacted upon. What we shall see with teleworking and everything actually is that there's more demand for technology. There's more demand for Internet of Things when it comes to cloud computing. And forgive the English expressions, but all these sectors are nonetheless very well located and situated, very well established for the next few years based on what we're seeing with our economy. In conclusion, this is an optimistic picture that we're trying to present, and to see an acceleration in economic growth, which is already reflected in the market and in long-term rates, which are increasing far more than short-term rates. It was always an excellent indicator, a very positive indicator of the economic momentum forthcoming. So separately and apart from the signs we're seeing a recovery, and the next step will involve leisure, entertainment, travel. These sectors will show the greatest potential for recovery, although it may be slightly delayed. But by at least 2022, we'll see a strong recovery in these sectors, which have known a decline for a few years.